Welcome to our YouTube tutorials. Today I'm going to look at the financial ratio analysis. Ratio analysis, as you may understand, is obtaining an inside look at the firm's financial efficiency, liquidity, revenue and profitability from the records that are there, or from the records that are given. So you may find that we want to understand or to be able to interpret how the firm is performing. The accountant will give us the information or reports on how the firm has performed, profit, generated assets, and so on. So this much in a certain period. But now, how do owners? Some of these owners don't understand what all that means. So we interpret those accounts by now having to prepare the inside view by using the ratio analysis. So ratio analysis is merely obtaining the look at the firm's functionality based on the efficient liquidity, revenue and profitability for a period of time. It can do 1 year or several years. So with the meaning I've already had actually the financial ratio analysis heading there, and then the classification. So I'm looking at the classification of the ratios, the financial ratios. So we have them as liquidity ratios, which actually assesses the liquidity of the firm. Leverage ratio, which look about solvency, how is the firm actually performing in respect to now the financial or the amounts of the assets that they have. Activity ratios, and then you have the profitability ratios. So those are the classification of the ratios that you have. So I'm going to start with the first one, which you talk of now as the liquidity ratios. Ratio. So liquidity ratios deal with actually measures the firm's ability to meet its short-term obligations. Measures the ability of the firm to meet its short-term obligation. So when we talk about short-term obligations, what short-term obligations are those now, for example, paying the salaries, paying for the supplies, paying the creditors, paying maybe rent, all the revenue expenses. How is the firm able to meet these short-term obligations? So that's sort of recognized the liquidity ratio there, liquidity ratio. So it measures the ability of the firm to cover any obligations that fall due at any time of the period. So we may have some purchases being needed in a firm. So when you buy goods, we need cash to buy them. So is the firm able to buy and pay for them as when they fall due? And whenever the creditors also demand to be paid, is the firm able to pay for those? So those are what we recognize the short-term obligations there. So you have things like the bank overdrafts. So here, like for example, purchases or creditors. We have maybe bank overdrafts. How are we going to cover this? We have maybe expenses, especially the revenue payments. We're able to pay for our revenue expenses whenever they fall due. We have maybe bits of exchange. I'm able to pay for this. So these are actually mostly the short-term obligations that we have in our organization. So the firm ability to pay this or to cover this, sort of recognize the short-term obligations. Now the ratio always is ideal when it's actually lower, but whenever the liquidity is high, then or the ratio is higher, then it means the firm is not able to meet the obligation. So you shall be seeing, I'll be calculating this, and you shall be seeing how it's presented. That the ideal ratio here is 1:1. The ideal ratio is actually 1:1. That's the ideal ratio in this case. Meaning, for every liability, there is one asset to cover it. There is one asset to cover it. Or actually you also have 1:2, meaning for every liability there are 2 assets to cover. So this may be ideal, but the best ratio that you can have in a farm is normally 1:2, meaning for every liability here, there's actually 2 assets here. There are 2 assets there, meaning one can be able to pay, and then the remaining one actually to be able to run the business. We'll talk about now the ideal ratio for that. So failure to meet this, actually this ratio here will mean the farm will struggle to meet its obligation, and it means actually its poor creditworthiness, and also may lead to litigation or insolvency of the company there. So meaning we're not able to meet our obligation, then they can sue us for insolvency or bankruptcy. So that's why the liquidity ratio is very important, that you should be able in a position to be able to meet our short-term obligations whenever they fall due. So we shall be mentioning that I've been doing actually the calculation of the same. Now we have the leverage or the gearing ratio. It was the first one. Number 2 is actually the leverage. Also referred to as actually the gearing ratio. It was referred to as actually solvency ratio. And this actually measures the extent to which the company uses its assets, which actually have been financed from the non-owner supplied funds there. So we'll consider the gearing ratio, meaning how is the firm utilizing the funds that they got from the external sources. Like we've taken a debenture, even as a company, we've taken a loan. So how are you utilizing those those loans there or the external sources to be able to finance your running of the business or acquisition of the assets? So when you consider this, we are seeing now the assets that we have, the assets that are there. We're comparing the assets value to actually the loans from out. So you've taken some loans from the financiers. How is it actually covering part of the assets that we have? So we may have maybe our own, out of this, we have now equity. You have the equity and you have the loans there. So our total assets here will be comparing now how much of the total asset is financed from loans and how much of it is actually financed from our own equity there. So we have maybe a 10 million total assets. Then the loan here is actually maybe 8 million. And then the 2 million from our own resources, meaning it's a highly actually geared. We say the firm is highly geared, meaning it's over depending on loans to run its activities, meaning the assets. If in case we are closing down the business, then their loans will take so much of the assets that we shall manage with very little. Like in this case, we only have 2 million being ours, but 8 million is actually outside that. So we always avoid the essence of now having to be highly geared, meaning over depending on loans to run the business. So you have to be, the better for us should be a low gear loan, meaning you're depending so much on our own capital to run the business, so that it should be the vice versa, that should be 8 or 6 for our own equity, and then the other 4 coming from actually loans that we've taken from outside there. So I'll be calculating that. So the gearing refers to the amount of debt finance a company uses relative to the equity financing. So we shall be relating now the equity to the loans there as the solvency or ratio. Now solvency here under the gearing ratio is where now we are seeing now how solvent is the business. You can also say as a business is solvent when it's depending on loans there. So you have very little loans and so much of the money that you are running using coming from the equity or own, then we say actually the firm is solvent. But if they were depending on outsider, then we say it's insolvent, meaning depending so much on outsiders. So that's what we have there, the financial leverage or gearing ratio there. Then number 3 is what we talked of now as the activity ratios. The activity ratios. And the activity ratios, as we are saying actually, is that measures the efficiency with which actually the firm uses its asset to generate sales there. So this one here, consider now how is the firm utilizing the assets to generate actually sales. How is it utilizing the assets to generate sales there? Because when you have assets in a business like worth maybe 10 million, then how much are they actually helping you to convert stocks into sales? So we shall be relating now the assets to the turnover, meaning how are they related? You may have assets which are worth 10 million when you're only making sales of 4 million or 2 million. So meaning now your assets are not being utilized fully to generate higher sales or higher profits there. So for you, a business to perform well, to grow higher or to grow faster, then you have to utilize more of the assets. The assets should not be lying in the farm. They should be working at all times, generating some income, so that now your sales actually will increase. And therefore, activity ratios will be measuring now how are we utilizing the resources that you have in the business to generate sales and income in the business. So that's what we as the activity ratios. And the last we have now the profitability ratios. Profitability ratios. The profitability ratios. The profitability ratios merely measures now how profitable is the business. How profitable is the business. So here merely goes to actually the profits with respect to the costs. So we shall be relating their profits to the cost that we carry there. So that's about profitability ratios. So this one will be measuring now our ratio between the cost of sales to the sales or to the profit that we have. And the general expenses to the profit that you generate. So we shall talk of now as the markup being the ratio between the cost of sales and the profit that you have. And then the margin being now the ratio between the cost, the operating cost, the gross profit that you or the net profit, either the gross or the net profit there. So let's talk of the profitability ratios. And this will actually be touching more on that, but we shall be relating now all the others, like the assets in respect to the profit generated. How much of the assets that you have are generating, or how much of the profits being generated because of the assets that you have. So that's what you have now as the profitability ratios in that regard there. So we measure the effectiveness of the return generated on the sales based on actually investment that we made in the business. So we shall be seeing how the profits are being generated in the company there. Now, maybe the last one that I did mention here, which I should actually be able to add there, is merely the investment or equity ratios. Equity ratios. Equity ratios. So that should be the last fifth one, which talk of now as the investment of equity. Equity ratios. And this was actually used to evaluate the overall performance of a company. I always used to evaluate the overall performance of a company. Like for example, you can determine the dividend policy. The dividend policy. So here we cut mostly the returns. The returns from investment. Mostly in companies talk about dividends. The dividends there. So these are now, if you're investing in a company, how much of the dividend will you be earning? So per amount, per share, or per equity that has been invested in the company, how much of the dividend is one earning? So we shall be considering that under the investment ratios there. So we shall consider also the pricing with respect to the dividend that you're earning. So we shall be considering the effect of the prices for securities and shares to the right issues and also to the productivity of the company. So whenever a company is paying higher dividends, then the price of that company or share price in the market should go up. If it doesn't go up, then what's causing it not to go up? So that's what we're considering under investment or equity ratios there under that analysis. So that's what we have for generally the definitions for those. I've talked about the liquidity ratios, which you have as the short-term obligations of the company. How is it able to purchase or to pay creditors? How is it able to repay back the overdraft that they have? How is it able to actually incur the revenue expenditures and pay for them in time? Meaning, are we having so much of the accruals, or are we paying so much of them in time? And then are we able to clear a piece of exchange whenever they arise or they fall due? That's now the bills payable. And then the second one is the leverage ratio, or the solvency, which I've said actually assesses the leverage solvency of a company. Does it over depend on loans, or does it actually use its own resources to run the business? Meaning now, are we taking the relation between the loans which you've given and risk or in regard to the or in comparison to the equity or on capital that is invested in the asset that we have there. And then we also have the activity ratios, which measures our ability to generate higher sales or profit using the asset that we have. And then profitability is now the ability of the firm to turn over, to convert stocks into sales, and how much the relationship between the cost and the profit that you're generating, the cost and the sales that you've made, the cost and the net profit that you've generated. That's under profitability ratios. And then the investment or equity ratios measures now the ability of the firm to pay back to the investors, in terms of the return on the investment. And then the relationship between also the dividends paid and the share security in the market, or the market price of that security there. So I'll be going with the calculation and the formulas that relate to the same. So these ones, each of them have actually formulas here. So I'm going to look at now the formulas that relate to the ratios that we have. So under liquidity ratios, we actually have two small subdivisions under the same. Under the liquidity ratios, which is the first one there, liquidity ratios. So we're going to look at the computation. Of the ratios. So the first one I said is the liquidity. Ratios. And I said under this one you have two subdivisions, which is of the current ratio. You have the current ratio. The current ratio there. That's the first one. So this one actually is computed by merely getting the ratio between the assets and the liabilities of the business. Now we're comparing how much of the assets that we have relate to the liabilities that we have. So this one is computed by current ratio being equivalent to the current assets over the current liabilities. Current liabilities, current assets over the current liabilities. That one actually will give us what covers the current ratio under the liquidity ratios. So we find that this one we are just comparing now the assets that you have to the liabilities that you have. So, and as I was saying, this actually the ideal ratio under this normal is actually 1:2, meaning for every liability there have to be two assets there. So that's what you have as the current ratio. That means that the company has more current assets than the current liabilities that are there. So, for example, if we have maybe we have $200,000 of the assets, and then you have maybe 140,000 of the liabilities. That's the current assets, this is the current liabilities. Then our ratio here will be, we're dividing this for 20 divided by 14. 20 divided by 14, how much that comes to, we need to calculate that. So that comes to 1.4. 1 is to 1.4. 1 is to 1.4. So meaning for every liability there are 1.4 of the assets there. So meaning there are more. We can be able to pay that liability with 0.4 of the assets there. So it's not actually the ideal which you said should be 1:2. Actually it's nearer to the ideal ratio there. So the 1 will be representing actually the liability, and then 1.4 will be representing the assets there. So you find that we shall always start with the liability. How many, for every liability, how many of the assets are there? That's how we actually present our ratios, and you'll be seeing that our ratio will be expressed either in decimal, this, or in percentage form. So this is the decimal part, where we say for every liability, there are 1.4 of the assets that are there. So that's what covers the current ratio there. So in this case, it means there are more assets than liabilities, 240. So 203% in that. So we can be able to pay our liabilities and maybe some money to still run the business. That will actually a good ratio there. Now the second under the same is what covers the quick ratio or acid test ratio. Quick ratio, or what also referred as the acid test ratio. The acid test ratio there. The acid test ratio. So quick ratio is just coming from the same, the current ratio. They are falling under the liquidity ratios, meaning measuring our ability to have or the liquid cash to be able to run our business. That's what it means by the liquid ratio, liquidity ratio. So the current ratio was merely all the current assets, comparing with them all the current liabilities. But when you come to the quick ratio, he will be comparing now how much of the quick asset, those assets that can easily be converted into cash, are there in respect to the current liabilities that are there. That when the creditors come, they want their money today. What are the assets that you convert into cash instantly and pay them? Those are the ones we talk about as the quick assets there. So the quick assets here, normally quick assets is always equivalent to the current assets minus stock. That gives us actually the quick assets there, meaning those assets are all the current and minus stock. Stock cannot be converted to cash instantly. You may sell and then you sell on your credit, so that cannot give you instant cash. So you always less it from the total current assets so that you get now the current the quick ratios there. So this one will be, the formula will be the quick ratio is equal to current assets minus stock over the current liabilities. Over the current liabilities here. So we take the current asset minus the stock over the current liability, then it gives you what covers the quick ratio as the formula there for our number. Now this one here, the ideal ratio we always say should be actually, the ideal ratio is always 1:1. Meaning for every liability, there has to be an asset which can easily be converted into cash very fast and then pay for the same. Like in this case now, originally we had 1.4 being the asset, so we can assume the 0.4 was the stock, but the 1 is the current asset that we have in that case there.